When it comes to investing money, too many choices can be confusing. I want to share what I believe is the best way to invest your money. Before we get into it, there are 3 steps for financial freedom according to expert Paula Pant. It's called grow the gap. This means you should increase the difference between your income and expense. You can do this by increasing your income or reducing the expenditure or doing both. After that, invest the gap and keep repeating this process. The number one order of priority in investing is the most boring in the investment list. So I put it away for later. The second order of investing is the provident fund. This is deducted from the salary but often lacks a tracking or a designated purpose. What exactly should PF achieve in your portfolio? Is it intended for a retirement pension or to handle emergencies during retirement? Make sure you've set up the access to your account. Ensure that your family knows your UAN number and they have access to the EPF passbook. The UAN ensures portability when changing jobs, allowing you to carry your PF account to your new job. Your contribution of 12% is matched by your employer and the fund grows at approximately 8% annually. I don't supplement this PF with a voluntary PF as I believe there's a potential for additional returns in riskier assets that align with my risk profile and in a more tax efficient manner. A notable advantage of EPF is the government backing, providing the highest security. Furthermore, the interest rates have remained unaffected by the decrease in overall interest rate. For example, the current expected EPF rate of 8.15% surpasses the 7.3% offered by 10-year government bonds. This is also more tax efficient. The third order of investing involves eliminating high interest loans, such as personal loans and credit card debt. If you find yourself carrying a balance on your credit card every month, prioritize clearing this debt instead of any other form of investing. Just by clearing these high interest debts, you are essentially securing a guaranteed 24% or a 36% annualized return, savings from the interest you would have otherwise paid. No other investments will yield such a significant return. A word of selfless advice: if you know someone rotating credit card balance while also investing in a mutual fund SIP, please alert them. Continuing the SIP might be counterproductive. Instead, they should prioritize in clearing their credit card debt. One food for thought: a person stuck with a high interest loan may consider taking a loan from PF to clear this off. Once you have cleared all the high interest rate loans, you will be surprised by the transformative impact it has on your financial life. The fourth is to max out the tax-related investments such as ATC. Maximum you can invest for tax break under ATC benefit is 1.5 lakhs, which also includes your PF contribution. You can consider ELSS mutual funds if you have limits available after factoring for the provident fund contribution. This might be a good fit as you might be young and you have enough time to let equity funds work for you. This has a 3-year lock-in. Outside of this ATCC, you also have another 50,000 limit available for National Pension Scheme, NPS. Fifth order of investing in priority is health insurance and term insurance. Healthcare costs are soaring. Medical inflation is at 14% and shot up tremendously in recent times. It is twice that of retail inflation. India's medical inflation is the highest in Asia. Cost of hospitalization has doubled in the last 5 years. Medical inflation erodes family wealth and eats into emergency funds. This is the biggest unknown risk in life. No one knows how much to save, what will be enough for medical emergencies. So the key investment is in health. Starts with an annual health checkup and medical insurance. Even with the medical insurance, there are a lot of exceptions one needs to be wary of, but having something is better than no cover. Same goes to term insurance, which is plain life insurance. As a thumb rule, have an insurance cover of 10 to 15 times your annual income. This way, your family will be able to maintain their current quality of life after adjusting for inflation. A word of caution: avoid purchasing insurance products labeled as investments. Keep investments and insurance separate. Opt for straightforward term insurance rather than unit-linked insurance plans or ULIPs. In specific circumstances, one might consider annuity product for their post-tax return optimization and diversification. Annuities can particularly be suitable for high net worth individuals, not solely focused on maximizing returns, but seeking stable fixed returns. Sixth principle of investing is aimed at growing your wealth. Its implementation should align with your age, risk profile, family situation, and financial goals. For those with high risk appetite, direct equity investments or equity mutual funds can be considered. They are effective hedges against inflation. The Nifty 50 index and active mutual funds have demonstrated an annual return of 12% to 14% over the past 25 years. To address long-term goals, a viable option is to make your monthly SIP investments in equity mutual funds. A SIP of Rs 10,000 a month over 25 years at 12% rate of return can compound to 1.88 crores. Even with a housing loan, especially with a 15 to 20 year horizon, the likelihood of the stock market outperforming a housing loan interest of 6% is substantial. Therefore, it is prudent to channel surplus funds into equity funds rather than a housing loan. While other avenues like commodities and real estate exist, equity investing remains the optimal approach for achieving the long-term financial goals. The last is the first order to invest, the rainy day fund. Before you invest in the stock market, your first priority is to set up a fund to take care of emergency. You can invest this in a liquid fund or a money market fund or simply a bank FD. As a thumb rule, 6 months monthly expenses should be put away here. Life will always throw surprises. Unless emergency fund is secured, we will end up diverting funds earmarked for crucial goals, thus breaking the power of compounding. When life derails our plan, we end up using credit cards. This sends us into deeper financial problems. Emergency funds ensure we do not get derailed. If you found this content useful, please consider liking this video and sharing with your friends.